Let's get straight into it, because volatility has been the name of the game as we know it, and all triggered by the kind of headlines that have been coming through from the Eurozone territory midway through this week. Some optimism coming through, but come today, some of that optimism petering out. What's your perspective on what we're seeing play out on that end?
I mean, there's two things. You know, today I think some optimism is coming out because Chancellor Merkel is giving an indication that it's going to be a marathon, not a sprint. So it's going to take a bit of time, and there needs to be sort of more fiscal union in the European community before the Germans are prepared to sort of help out. And I think that's actually the rational approach. You know, they're not prepared to write a big check unless they can be sure that the fiscal deficits and the debt will be actually handled by the southern European states. So
absolutely. And in the meantime, it's triggered economic slowdown fears globally. I mean, we've had those liquidity fears being highlighted, certainly by the move that China took this week with easing policy on that. And that came as somewhat of a surprise, even though we've had speculation about it in the market. It's a change in stance. What are you made of that?
I think, you know, the fact that the People's Bank of China eased the triple R, as they call it, just indicates how seriously that they view this whole crisis. You know, half of their GDP growth rate's got to come from their consumer, half from investment. So clearly they're seeing a consumer slowdown. I think the calculation is they released about $64 billion, you know, into their own market by making those changes. So I think they view it very seriously. And unfortunately, you know, we had a very big move yesterday, the day before yesterday. What's interesting is that we did some analysis, my colleagues in Morgan Stanley, and it was the fourth biggest end of month move in the S&P 500 history. Unfortunately, in the three or the four occasions before, you ended the S&P 500 down sort of 10% in the month after. So it just gives you an indication that we're having very volatile, very high rallies, but you know, fundamentally the problem is still there.
So let's look at the South African market in that context, because up to now it's proven to be pretty resilient. We've seen a pretty flat performance on the JSE All-Share Index. What's your South Africa outlook?
Look, we've just released our South Africa outlook, and just to contextualize it, you know, South Africa is basically up 1 or 2% in rands, but it's down about 15–16% in US dollars. MSCI is around about the same thing. So for a US dollar investor, it's been pretty painful for everyone. For next year, we're expecting about 10% return, which sounds pretty decent, but our long run trend is around about 18%. So we're expecting sub-trend returns for the next year, and that's sort of built on, you know, all the usual facts. Our consumer is highly leveraged, the global crisis, the fact that we're very correlated with international markets. Our view, you know, we're going to see slight derating, and it's very hard to see a re-rating of our market when you're going to see the bulk of the markets being derated.
Yeah, let's take a look at things on a sector basis here, and what you're favouring at this stage of the game, where you're anticipating this re-rating of the markets and of course that possible upside come 2012.
Look, there's two areas. You know, one, we're going to sound a little bit like a broken record because we were too early on construction. We think construction is worth looking at now for three main reasons. You know, number one, if you look at the order book relative to the share prices, you know, the jaws is opening up quite substantially, so we think that's the one opportunity. The second one is if you look at something like Murray & Roberts, you know, Roy Campbell did some work for us and showed that if they get sort of 30% of the claims on Gautrain and GP MOF, that issue that they've got in Australia, you know, you could get 8 Rand a share in free cash flow in 2014. Now that's 30% of the current share price. So that's, you know, relatively optimistic. And then obviously we've got cement volumes that are positive year on year at this point in time. So the market is telling you the share prices are heavily hit, and we think there's some turnaround coming. That's the one. The second would be on the healthcare. Now, we very much recognize that the national health insurance is a longer term plan. But clearly, you know, if you look at the headline numbers, 234 billion Rand, you know, that's 32% of our current tax take. It's a big number. It's probably not going to be as high as that, but they're small sectors. So if you even get some movement towards it, which we would expect to look for the budget for 2012, some indication, maybe a couple of billion for that could move that sector quite significantly.
Could is the operative word at this stage. So let's look at these two sectors, you know, separately and hone in on construction specifically, because the major question out there is, yes, we've got valuations sitting low. Yes, that upside potential is high, but where's that money going to come from? Because if you're looking at within South Africa, we've been seeing the promise of what, an 800 billion Rand infrastructure spend that has not filtered through. And the question is, when is that going to come through?
Good question. I mean, the interesting thing is that of that 800 billion, about 280 billion is electricity, which is coming through. So that's Kusile and Medupi that is actually working its way through. The second thing that we'd expect is on the roads. Now, obviously, there's a lot of issues about SANRAL, but fundamentally, I think we all agree. You know, we've got the roads. You've got to pay for it. They have been promulgated as toll roads. Either we're going to pay tolls, or there's going to be shadow tolling, as they call it from government. So, you know, you're going to pay for the infrastructure, or do we have another crisis? You know, you end up with gridlock. We build more roads and then we pay for it. That's pretty much what happened to electricity. So at some point that comes through. I agree with you, it's been delayed. But remember, if you go back to previous cycles, the share prices typically move 12 to 18 months ahead of the earnings. So, you know, our argument would be, you know, why 2012, why not 2011? We're heading towards, you know, the ANC elective conference. The big issue is we're not creating jobs. You know, construction jobs are relatively easy to create. So we would think as you head towards the middle of the second part of the year, that could be the way that you create some jobs.
I ask the question because some of the construction players themselves are not too optimistic about that picture moving forward. I mean, over the last couple of weeks, we've heard commentary come through to the market where they're emphasizing moving away from South Africa's borders and leveraging off the African growth potential more so than anything else.
But that gives you the opportunity. Your Venge and your Murrays are getting, you know, 40% of the exposure to South Africa. The rest is mining, Australia and outside. So you get a bit of a call option on South Africa. And that's why we're very interested in those kind of stocks.
Let's move on to what you highlighted within the healthcare space and leveraging of the National Health Insurance Scheme as well, because a key to that will be management of that process between private sector and government as well. What's the status as you see it in that regard? Because in focus is going to be PPP structures.
Look, I think it's going to be difficult and painful and slow. I mean, these things always are. You know, I think the bottom line is that the private sector has the ability to execute on it. Government wants to make very sure that it gets bang for buck. I mean, what is very interesting is that 234 billion we speak about assumes that there's a 30% efficiency gain because it's done by the government. Now, if you scale it up to the 334 billion, it's an even bigger number on a very small sector. It's going to take time, but, you know, markets discount ahead. So if we have any kind of movement with regards to that, we would expect to see some share price action.
Is that some of the rationale that translates to your view on resources over financials over industrials? Because we know that looking at some of the valuations, for example, on our diversifieds within that resource complex, they're sitting historically low right now.
I agree with you. You know, unfortunately, it's slightly more complicated. You know, we break up the resources. We are very negative on oil as a house. You know, we think the global slowdown will impact the oil price more than it will impact the bulk commodities. So you would argue that an Anglo-American would be better off than a Sasol. That's certainly our view. The market is saying no up until this point in time. But, you know, if you look at the beta, which is the sort of the reaction to the oil price, typically any slowdown in GDP has a disproportionate impact on the oil price. Now, obviously, Iran is in the front of our minds at the moment, so that's a bit of a concern. But we would distinguish between an Anglo and a Billiton and a Sasol. So very much overweight the Anglos, underweight the Sasol in this kind of environment.
Then it would have been good news, the fact that Sasol announced that possible divestiture from its operations in Iran, for example.
It would. But, you know, clearly if you just look at the correlations, it's very much an oil play. It's basically a rand oil play. And, you know, if oil price comes off, certainly Sasol is going to experience some weakness.
I must say, Vaughan, one of the very few that has Sasol on the back burner at this stage. Let's take a look at your strategy when it comes to emerging markets versus the developed markets right now. Look,
again, Jonathan Garner, our strategist, has released his piece. We have quite a contentious view. He's looking for 30% upside on GEM. Now, if you break it down, it's effectively Asia, then Latin America, then EMEA. And EMEA, for which we fall underneath, is the least liked because it's most exposed to Western Europe, obviously the banking crisis. South Africa, we've got overweight because it's more defensive. So really what Jonathan's saying is that a re-rating because on Asia, simply because the returns on equity are a lot higher, valuations are attractive, and emerging markets is the place to be for next year.
You talk about some of the caution coming through to the likes of African markets because of their exposure to the European territories. Is there enough focus and emphasis being placed on Chindia and that potential right now? Are we waking up fast enough?
It's a difficult one. You know, we've got a very strong view on China and a less strong view on India. You know, it boils down to issues like bureaucracy. you know, the ease of doing business. So we're very overweight China and very underweight India, unfortunately. You know, so there's real potential. They're both very large markets, but India, I beg your pardon, China is the bet that we're making.